Let's jump right in. Welcome to this explainer. Today, we are tearing down the structural reasons why the vast majority of retail traders lose money, and more importantly, we're unpacking the exact data-backed framework the pros use. We're skipping the usual cliches, the whole it's just bad psychology thing, and diving straight into the real mechanics: market timing, liquidity, and precision execution. Okay, let's face this alarming reality right off the bat. If you look at broker risk disclosures, specifically the data from European regulators like ESMA, it shows that 70 to 80% of retail CFD traders are actively losing money. That is a staggering statistic. And for years, the industry has just pointed the finger at emotions. But actually, the data tells a totally different story. It's not just a lack of discipline. It's a fundamental structural flaw in how they're engaging with the market. And this right here brilliantly illustrates the root cause. There's this seminal study by Barber and Odean, and it proves that overtrading and transaction costs are the real account destroyers, not necessarily bad entries. It's literally death by 1,000 cuts. When you crank up your trade frequency without actually increasing your edge, your profitability just rapidly evaporates against the spreads and your own impatience. So, to fix this, here is our roadmap for today. 1. Why retail traders lose. 2. The 4 trading sessions. 3. The London-New York overlap. 4. The New York reversal. 5. Perfecting the trade entry. And 6. Professional risk management. Let's get to it. Kicking things off with Section 1. Why retail traders lose. The structural flaws. Now, this is wild. It is incredibly frustrating to predict the market correctly but still bleed capital, right? Well, according to data cited by pro trader Tom Hugard, most retail clients actually have more winning trades than losing ones. So what's the problem? They lose £1.66 for every £1 they win. Why? Because of terrible risk management, using fixed stops in volatile conditions, oversizing positions, and the absolute ultimate account killer, averaging into losing trades. Basically, they're risking way too much to make way too little. Moving right along to Section 2. The 4 trading sessions, the global clockwork. You really need to think of the market as this giant, invisible clockwork, a global financial baton relay that literally never sleeps. It flows seamlessly from the Asia-Pacific Open in Sydney and Tokyo right over to the global capital of London, and then finally lands in the Americas hub in New York. This continuous loop means currency values and indices are always reacting, but and here's the kicker, the volume of those reactions varies wildly depending on which time zone happens to be awake. By understanding the unique liquidity and volatility profile of each session, you stop trading blindly. You can actually align your strategy with the heavy institutional volume. Sydney? Well, that's typically range-bound, lower volatility, mostly focused on Aussie and Kiwi pairs. Tokyo brings in those fixed institutional flows and strong yen action. But then, London wakes up, and that's where we see the explosive volume, the massive breakouts, and the tightest spreads. Finally, New York steps in, bringing supreme US dollar dominance and high-impact economic news. Which brings us perfectly to Section 3, the London-New York overlap, the ultimate sweet spot. The crucial point here is knowing exactly when to trade, and this window stands head and shoulders above the rest. The London-New York overlap captures up to 70% of the daily trading volume. We're talking tighter spreads and the serious momentum you need to avoid those choppy, range-bound traps. This 4-hour window, roughly 1300 to 1700 GMT, is when Europe and North America are actively trading at the exact same time. It's action central. Institutions are executing the bulk of their daily orders right here. So for you, it means reduced slippage and sustained directional moves. If you want to maximize your edge, this is the time of day you need to be at your screens. All right, Section 4, the New York reversal. Strategy unlocked. Let's get into the actual setup. Now that we know when the volume peaks, let's explore a highly actionable strategy for this specific window. The foundational logic here is simple but powerful. London creates the intention and the initial move, but New York actually completes the objective and reverses the market. See, London might push the price heavily one way, setting up a narrative, but it often stops just short of a major higher time frame target, like a previous day's high or low. Then, boom, New York opens. That surge in institutional volume provides the fuel to aggressively push into that untouched level, sweep the liquidity sitting there, and completely flip the direction of the market. This brilliantly illustrates that classic rhythm we see all the time. Asia quietly consolidates. Then, London breaks out aggressively, totally convincing retail traders that a new trend has formed. But during the New York Open, the market dips one last time. It sweeps the lowest point of London, grabs all that liquidity, and then aggressively reverses the trend upward. It's a trap, basically.
During the New York Open, institutions intentionally engineer these liquidity sweeps to grab retail stop losses. They do this to secure the massive order fills they need to reverse the market efficiently. I mean, think about it. Large banks can't just click buy on a massive position without sending the price to the moon. They need counterparties. So retail stop losses are essentially the rocket fuel institutions use. They push the price past the highly visible level, trigger the early buyers out, and trap the late breakout traders. Once those retail orders are absorbed, smart money reverses the market and leaves the retail crowd trapped.
So how do we trade this without getting caught? Section 5, Perfecting the Trade Entry, Micro-Execution.
Identifying the stop hunt is great, but you have to know exactly how to execute your entry. Here's what you should wait for on the chart. The price spikes to trigger the stops, but instead of continuing, it immediately violently breaks down. Now, if you're an amateur, you're probably buying that initial breakout. But smart money? They wait. They watch the sweep happen, wait for that violent rejection, and use that collapse as confirmation that the reversal is actually genuine.
Okay, so here is your mechanical playbook. Step 1. Wait for the targeted liquidity sweep, usually between 1330 and 1600 GMT. Step 2. Watch for the structural break, which we call a market structure shift, or MSS. This means the price stops respecting the old trend, like suddenly breaking a recent higher low with strong impulsive momentum. Once you see that shift, whatever you do, do not chase the price. Wait for it to pull back into an inefficiency left behind by that impulse, the fair value gap, or FVG. You enter the trade right there, patiently, where your risk is heavily defined.
And what's really interesting here is how executing these entries right at the edges of the previous day high or low gives you an incredibly asymmetric risk-to-reward ratio. By entering only after the market has swept these major external liquidity pools, you can tuck your stop loss tightly just above the sweep. It's a tiny, highly calculated risk, but you're aiming for a massive structural target on the total opposite side of the range.
Of course, none of this matters if you blow your account. Section 6, Professional Risk Management, the Survival Guide.
Even the perfect New York reversal setup is going to fail you over time if you don't master risk management. The absolute crucial point here is adopting institutional survival habits. We're talking about heavily capping your risk to a strict maximum of 0.25 to 1% per trade. Amateurs will widen their stops when a trade goes south, just hoping it turns around. Or worse, they average into losers. That's a one-way ticket to blowing your account. Professionals know that any single trade is literally just a probability. By capping your risk tightly, you easily survive the inevitable string of losses without destroying your capital base.
The data is crystal clear on this. Lowering your trade frequency, strictly defining your expectancy, and journaling your structural mistakes, these are the actual keys to long-term profitability. Remember Barber and Odin from the beginning of this explainer? Overtrading is the ultimate enemy. By strictly waiting for setups like the confirmed New York reversal during peak overlap hours, you naturally take fewer trades. You adjust your position sizes based on current market volatility, and you log your trades to ensure you are actually executing your edge and not your emotions.
As we wrap up this explainer, I really want you to take a hard look at your own trading history and ask yourself this final, critical question. Are you trading the market's true structure, or are you just providing liquidity for someone else's strategy? Think about that. The next time you see a massive spike right at the New York Open, pause. Wait for the sweep, watch for the structural shift, and manage your risk like a professional. Thanks for joining me on this deep dive into market mechanics.